You know, when we look at something like a modern manufacturing assembly line, there's this expectation of just, well, absolute frictionless automation.
Oh, completely. It's the ultimate fantasy of efficiency.
Right. You press a single button and the robotic arms, they just whir into action. Laser sensors align the parts and out pops a perfectly assembled machine. It's clean, it's engineered predictability, and frankly, it's sort of what we've come to expect from technology in the 21st century.
Yeah, we want complex, chaotic, difficult processes to be reducible to a single effortless button press. I mean, we want the machine to absorb all the friction so we don't have to deal with it ourselves.
Exactly. But then you step into the world of financial markets, and suddenly that perfectly automated factory narrative completely falls apart. We're looking at a landscape that is constantly sold to us as an engineered assembly line, especially right now with this absolute fever pitch around artificial intelligence.
Oh, the hype is deafening.
It really is. Everywhere you look, there's a promise of an algorithmic shortcut to financial independence. Just buy the software, plug in this AI script, let the neural network do the heavy lifting, and go sit on a beach, right? But under the surface, the reality is incredibly murky. It's chaotic.
It is the absolute definition of financial muddy waters. The gap between, the marketing pitch of automated trading and the mathematical reality of how markets actually function is staggering. And it's a gap that costs retail traders billions of dollars every single year.
And that is exactly what we are wading into today. Welcome to the deep dive. We are opening up a fascinating set of research today, specifically a dossier titled The Architecture of Alpha, prepared by Kumo Solutions Flitti.
It's a brilliant breakdown.
Yeah, the mission here is to separate the dangerous, highly lucrative hype of retail automated trading from the actual quantitative reality of the world's most successful institutional funds. We want to figure out why the retail trading robots that you see advertised on your social media feeds consistently wipe out accounts, while institutional quants using what sounds like the exact same technology are generating billions in profit.
Right. And the core revelation we're going to unpack is that true financial mastery is absolutely not about finding a magic tool or a predictive robot. The kind of mastery exemplified by legendary figures like the late Jim Simons is the exact opposite.
It's just a totally different game.
It really is. It's about a grueling, mathematically rigorous discipline that acts as a force multiplier for human expertise. If you don't have the expertise first, the tool isn't just useless, it is actively destructive.
So let's start right there with this whole idea of the magic tool. Because this AI revelation we keep hearing about in the retail trading space, it isn't actually new, is it? I mean, it feels like we've been here before.
We absolutely have. What we're seeing currently is largely just a sophisticated, glossy rebranding of a very old, very broken concept. I mean, for decades, the retail market has been plagued by trading robots and what the industry used to call expert advisors, or EAs.
Oh, man, I remember those pop-up ads from 15 years ago. Make money while you sleep. Beat Wall Street from your laptop.
Precisely. And if we look at the historical context from the dossier, the mechanics of those old expert advisors are incredibly revealing. Historically, those tools relied on rigid, hard-coded rules.
Right.
A programmer would write a script that essentially said, look at these two moving averages. When the 50-day moving average crosses above the 200-day moving average, execute a buy order.
Okay.
And when the RSI indicator hits 70, execute a sell order.
Which, I mean, it sounds logical on paper. If A happens, do B.
It sounds totally logical until you understand market microstructure. The primary marketing hook was effortless passive income. But the reality is that financial markets are not static environments. They are dynamic, non-stationary systems. They undergo regime changes.
Meaning the whole environment shifts?
Exactly. A strategy that works beautifully in a low volatility, trending bull market will instantly self-destruct the moment the market shifts into a high volatility sideways chop.
So what exactly happens under the hood when that shift occurs? Like, why does the robot break?
Well, imagine a macro news event drops, say, an unexpected interest rate hike or a geopolitical crisis. In a fraction of a second, the institutional market makers, the entities that actually provide the liquidity that allows you to buy and sell, they pull their orders. They step back to reassess the risk.
Okay, that makes sense.
And when liquidity dries up, the bid-ask spread, which is the difference between the highest price a buyer is willing to pay and the lowest price a seller will accept, it widens dramatically. It goes from 1 cent to 50 cents or even dollars.
Wow, and the hard-coded robot, it just doesn't know that.
Exactly. The rigid robot just sees that its moving average crossed. It blindly submits a market order into a vacuum of liquidity. That order experiences massive slippage, Instead of buying at $100, it gets filled at 105.
Ouch.
Then the market snaps back, the robot's stop loss is triggered, and it sells at 95. It just lost $10 in a microsecond because it lacked the contextual awareness to understand that the environment had temporarily broken down. It just marched the portfolio right off a cliff.
And now, fast forward to today, instead of calling them expert advisors, marketers have just slapped the AI label on these exact same fragile scripts.
It's just the evolution of hype. We went from trading robots with their hard-coded if-then scripts to algorithmic trading, which promised high-frequency speed. And now we've arrived at the current AI and machine learning phase. And the marketing hook today is even more dangerous.
How so?
Well, they say the machine predicts the future. It promises deep pattern recognition and predictive modeling.
But wait, hold on. Institutional high-frequency trading firms actually do use algorithmic trading. And huge hedge funds absolutely use machine learning. So why can't I? Like, if the technology exists, why is the retail version just a rebrand of older, rigid models?
Because of the infrastructure and the data. This is the crucial distinction here. Institutional machine learning thrives because it is built on three massive pillars: pristine data, vast technological infrastructure, and the deep mathematical oversight of true quants.
Okay.
When an institution feeds data into a machine learning model, they aren't using the delayed, noisy, aggregated price feed you get from a retail brokerage API. They're using oceans of clean, tick-by-tick historical data, alternative data sets like satellite imagery or credit card receipts, and direct co-located feeds from the exchange itself.
Colocation, meaning their literal servers are sitting in the same physical building as the NASDAQ servers, so they can cut out a few microseconds of latency, right?
Exactly. They are processing this data through supercomputers, constantly monitored and adjusted by teams of PhDs in physics and mathematics. The retail versions of AI are entirely devoid of that massive infrastructural context.
Right. I mean, you are basically buying a static script, running it on your home Wi-Fi connection, feeding it delayed data, and expecting it to outsmart a supercomputer sitting in New Jersey.
That's exactly it.
So to go back to our factory analogy, it's like someone selling you a single robotic arm on the internet and promising you can build a Ferrari in your garage, ignoring the fact you don't have the power grid, the raw materials, or the engineers to make the arm do anything useful.
That is a perfect way to visualize it. And yet people keep buying these tools. Millions of dollars are spent on them every single month.
Which brings up a really fascinating psychological question. If these tools have been failing for decades, why do we keep falling for the rebrand? Like, why are we so desperate for the magic tool?
It stems from a very deep, very human desire to bypass the grueling learning curve of mastery. Financial markets are incredibly complex. Learning to navigate them profitably requires thousands of hours of intense study, emotional regulation, and painful trial and error.
Yeah.
Human nature instinctively seeks the path of least resistance. We want the reward without the crucible.
And that vulnerability creates the perfect ecosystem for predators.
It creates what the research brilliantly categorizes as the ecosystem of the well-spoken idiot.
I cannot get over that phrase. The well-spoken idiot, it's so visceral.
It perfectly captures the dynamic. These are individuals who are exceptionally skilled at marketing. They have great lighting, rented sports cars, and incredibly persuasive copywriting. They're selling ineffective tools to buyers who fundamentally lack the foundational knowledge to tell the difference between a real quantitative edge and a statistical anomaly.
So it's an asymmetry of information.
Exactly. If you don't understand the underlying mathematics of variance, probability distribution, or market mechanics, you cannot distinguish between statistical noise and high-quality research. You look at a backtest the marketer provides that shows a 400% return over 2 years, and you believe it's a genuine edge.
But let's dig into that for a second. How do they fake the backtest? If a tool shows a verifiable historical return, how is it a scam?
Through a process called curve fitting or over-optimization. A marketer can take any random script and tweak the parameters endlessly until it perfectly captures every single price movement that happened in the past.
Oh, I see.
Yeah, they build a robot that only buys on Tuesdays when the moon is full and the price is exactly $50. In the historical data, that exact combination happened to result in a massive spike. So the backtest looks flawless, but it has absolutely no predictive value for the future. It's just fitting a curve to random historical noise.
And the buyer just doesn't know the difference.
The buyer truly believes they are purchasing a shortcut to wealth. Meanwhile, the seller often knows perfectly well that the tool lacks sustainable value. Or worse, the seller knows that whatever slight, legitimate edge the tool once possessed has already been completely arbitraged out of the market.
Arbitraged out, meaning the big institutions already found that specific inefficiency, exploited it with their supercomputers, and closed the gap so it doesn't exist anymore.
Precisely. It is a predatory ecosystem where strategies that institutions discarded 5 years ago are repackaged and sold as cutting-edge secrets to the retail crowd.
It makes me think of a shady mechanic. Like imagine a mechanic selling a $500 bottle of, I don't know, quantum engine additive to a teenager who just got their driver's license and doesn't even know how to check their own oil. The kid thinks this glowing blue liquid is going to turn their rusty '98 sedan into a Formula One race car, but the mechanic knows it's just tap water mixed with food coloring. The kid lacks the mechanical knowledge to understand that speed comes from the engine block, the transmission, the aerodynamics, not some magic liquid.
And that raises the most critical question of this entire discussion. If the magic liquid is fake, but we know professional race car drivers still use advanced tools, what is the correct way to view the relationship between a human operator and advanced technology?
Right, because clearly professional quants are using machine learning. They aren't sitting at their desks doing calculus on an abacus.
No, of course not. So if retail AI is largely an illusion, how do the actual professionals interface with their algorithms without falling into the exact same trap?
Yeah, how do they?
Well, this requires a complete paradigm shift in how we view automation. The research introduces a vital metaphor here. It compares a professional trader using advanced AI to a highly skilled professional golfer using a world-class caddy.
The golfer and the caddy. Okay, I like this. Let's break down the mechanics of this relationship.
In this scenario, the AI, the algorithm, the machine learning model is the caddy. What is the job of a truly elite caddy? Their job is to process massive amounts of complex environmental data. They map the exact topography of the course. They read the subtle, invisible slopes of the greens.
They assess the barometric pressure, gauge the wind direction.
Exactly. They measure the exact yardage to the pin down to the inch. They also look at historical data. Like, how has this specific golfer played this specific hole under these specific weather conditions over the last 5 years?
So in trading terms, the caddy is doing the quantitative heavy lifting. They're running the risk models, executing the sentiment analysis across millions of news articles, scanning the order book for hidden liquidity, and running millions of Monte Carlo simulations to backtest probabilities.
Exactly. The caddy has the laser rangefinders, the GPS devices, the weather radar. They synthesize all that beautifully processed data, and they hand a recommendation to the golfer. They say, based on the wind and the slope, you should hit a 7-iron, aim 3 yards left of the pin, and put backspin on the ball.
And this is where the retail fantasy dies. The caddy doesn't swing the club.
The caddy never swings the club. The human trader, the golfer, retains absolute non-negotiable responsibility for the strategic intent. The golfer must make the final decision.
Yeah.
The golfer has to evaluate the caddy's data against their own internal intuition, maintain emotional composure under immense psychological pressure, and ultimately execute the physical swing.
Because at the end of the day, Tiger Woods is still Tiger Woods, even if he doesn't have a caddy. But you could give me the greatest caddy on the face of the earth, equipped with military-grade GPS, satellite wind gauges, and a supercomputer in their backpack, and I promise you, I am still going to shank the golf ball straight into the woods.
Because you lack the foundational mechanics of the swing. And that perfectly illustrates why human judgment remains absolutely essential, even when you are utilizing the most advanced technical tools available. The research draws a very hard line here. The advice generated by an algorithm is only as good as the brain receiving it.
That is such a powerful concept. The advice is only as good as the brain receiving it. If my brain doesn't understand the geometry of a golf swing, the yardage data is useless to me. How does this play out in the financial markets when the trader's brain isn't up to par?
It results in a catastrophic failure of conviction. Think about what happens when you're in a trade. It's not a static event. The market is constantly moving, vibrating. Your position will go into drawdown. You will see red numbers on your screen.
Yeah, that's always fun.
Right. If you are blindly following a signal from an AI that you don't deeply, intimately understand, if you don't know the mathematical why behind the algorithm's decision to buy, you will completely lack conviction.
And when you lack conviction, psychology takes over.
Fear takes over. The moment the trade goes against you, the moment there is turbulence or a sudden volatility spike, you will abandon the strategy. You'll panic sell at the exact wrong moment. You won't have the stomach to hold the position through the variance because you have no foundational belief in the structural geometry of the trade. You are just a passenger in a car you don't know how to drive.
And the moment the car hits a patch of ice, you grab the steering wheel and jerk it into a ditch.
Precisely. There is a medical analogy in the text that reinforces this beautifully. Consider a highly trained neurosurgeon. Today, surgeons use incredibly advanced robotics, 3D imaging software, and microscopic cameras in the operating theater. Those tools enhance their human precision to an unbelievable degree. They allow a surgeon to operate on a scale that the human hand simply cannot achieve alone.
But handing a $1 million robotic scalpel to a random guy off the street doesn't magically turn him into a neurosurgeon. It just makes him an incredibly dangerous guy with a robot arm.
Exactly. It raises a profound point about the epistemology of tools. A tool is only advantageous to an operator who has already invested years in mastering the underlying craft. Without that prior study of human anatomy, of the nervous system, of surgical techniques, the layperson doesn't even have the capacity to know if the robotic scalpel is helping them or actively destroying tissue.
They can't audit the tool's performance.
Exactly. Retail trading robots cannot mimic the edge of a professional because the algorithm entirely lacks the golfer's intuition. And we need to be clear about what intuition is in this context. It's not a mystical feeling in your gut. It's not a psychic prediction.
What is it then?
Market intuition is the physical, neurological result of thousands of hours of intense market exposure. It is the brain's subconscious ability to recognize complex, multidimensional patterns of liquidity, momentum, and risk that it has seen play out hundreds of times before.
So, if the ultimate goal here isn't to scour the internet for a robot to do the work for us, but rather to build our own deep intuition so we can eventually be the master of these advanced tools, what does that mastery actually look like at the absolute highest level? Like if we zoom all the way out, who is the ultimate golfer?
To answer that, we have to look at the legacy of the most successful quantitative trader in modern financial history. We have to look at James Harris Simons.
Jim Simons, the absolute legend of the quantitative world. He just passed away recently, right? In May of 2024 at the age of 86.
Yes, and his life, his career, and his methodology epitomize the exact polar opposite of the magic tool shortcut we've been discussing. Jim Simons didn't just beat the market. He fundamentally solved it in a way no one else ever has.
Yeah.
His firm, Renaissance Technologies, and specifically their flagship medallion fund, achieved a compounded average growth rate of approximately 66% over 33 years before fees.
I just want to pause and let that number sink in for you listening. 66%.
Yeah.
Compounded every single year. For 3 decades, that number is so large it almost defies conventional financial logic. It breaks your brain a little bit when you try to calculate the exponential growth of that.
It is the greatest track record in the history of investing. Warren Buffett, George Soros, Ray Dalio, none of them even come close to the pure, unrelenting consistency of the medallion fund. And the most fascinating part is how Simons achieved this. He didn't do it by chasing the latest Wall Street fads.
Right.
He didn't do it by reading earnings reports or guessing what the Federal Reserve was going to do. In fact, he famously avoided hiring traditional Wall Street traders entirely.
Right. He didn't want MBAs. He wanted scientists.
He hired brilliant physicists, astrophysicists, mathematicians, and computer scientists. He treated the financial market not as a place for intuitive gambling or fundamental economic analysis, but as a deeply complex, chaotic system that could be decoded through intense data-driven mathematical rigor.
The research highlights his background, and it is the skeleton key to understanding his edge. He wasn't a finance guy. He was a deeply respected, award-winning mathematician. But more crucially, he was a former code breaker. He worked in cryptanalysis for the IDA, the Institute for Defense Analyses, for the United States government during the Cold War.
And that specific background in cryptanalysis is the key to everything Renaissance Technologies became. Think about the fundamental nature of what a code breaker does. They are presented with a massive ocean of intercepted data that appears to be absolute, chaotic randomness, pure noise.
Yeah.
And they possess the mathematical frameworks required to locate a tiny, hidden signal of truth, a structural pattern buried deep within that chaos.
And that is exactly what the financial markets are. They are a cacophony of millions of humans and machines buying and selling for millions of different conflicting reasons. It looks like pure noise.
Retail traders look at that noise and they rely on simplistic, two-dimensional tools. They draw a few lines on a chart, they look at a moving average, and they try to guess the future. Simons looked at that same noise and applied the systemic, multidimensional mathematics of code breaking to locate structural, hidden inefficiencies that were completely invisible to the naked eye.
Okay, let's unpack this right here,
Yeah.
because I think this is where a massive disconnect happens for the everyday investor. When we say Jim Simons used deep mathematical rigor, what level of math are we actually talking about? Because I'll be honest, a lot of retail traders think that calculating a standard deviation or drawing some Fibonacci retracement lines on a basic candlestick chart makes them a highly sophisticated quant.
The chasm between drawing a Fibonacci line on a screen and the mathematics Simons was deploying is like the chasm between playing with wooden building blocks and engineering a controlled nuclear fusion reactor.
Wow.
It is an entirely different universe of human intellect. The research provides a specific proxy to help us understand this depth. It's called the Chern-Simons framework.
Okay, I have never heard of this. What exactly is the Chern-Simons framework?
Jim Simons developed this mathematical theory in 1974 in collaboration with a renowned geometer named Xiang-Shen Chern. The Chern-Simons theory is a three-dimensional topological quantum field theory.
Okay, just the string of words, three-dimensional topological quantum field theory is incredibly intimidating. Break that down for us. What does topology actually mean, and how on earth does it relate to the stock market?
Let's simplify it. Topology is a branch of mathematics that studies the properties of a geometric object that are preserved even when that object is stretched, twisted, or deformed, as long as it isn't torn or glued together.
Like the old joke that a topologist can't tell the difference between a coffee mug and a donut.
Exactly. Mathematically, if they are made of perfectly malleable clay, you can mold a donut into the shape of a coffee mug without ever tearing a new hole in the clay. The hole in the middle of the donut becomes the hole in the handle of the mug. Therefore, topologically, they share an invariant property. They have the same fundamental shape.
Okay, I'm tracking the clay donut, but how does that apply to billions of dollars in stock market data?
Well, think about the market's price data as a massively complex, multi-dimensional shape moving through time. When a massive volatility event happens, like a market crash or an earnings surprise, the shape of the market is violently stretched, twisted, and deformed.
Right.
A retail trader's basic indicator breaks because it only measures the surface level distance. But a mathematical topologist is looking for the invariant properties. They are looking for the hidden structures, the relationships between thousands of different assets that remain mathematically true regardless of how violently the market is deforming.
So while retail is panicking because the chart looks scary, Simon's algorithms are calmly identifying that the fundamental topological structure of the relationship between, say, the price of crude oil, the Japanese yen, and a specific basket of tech stocks hasn't actually broken.
Precisely. They are finding the signal in the absolute extreme noise. And to understand the caliber of this math, you have to look at where else the Chern-Simons theory is used today. This isn't just abstract academic theory. This exact mathematical framework is used in condensed matter physics to describe topological order in fractional quantum Hall effect states.
Wait, really?
Yes, it provides the mathematical basis for non-abelian anyons, which are the fundamental particles required to build topological quantum computers.
So the man who built the most profitable algorithmic trading firm in human history was literally doing the foundational mathematics that currently underpins quantum computing and string theory.
Yes. His mathematical work from the 1970s still deeply influences theoretical physics and string theory today. This proves the incredible long shelf life of true, rigorous, foundational discovery. It reveals the immense, almost comical chasm between the retail robot promising effortless wealth and the true level of quants.
It's just not the same game.
Not at all. The arena where Renaissance Technologies operates is an arena where only individuals who have spent decades mastering differential geometry, topology, and stochastic calculus can even understand the language being spoken, let alone the algorithms being written.
That is deeply humbling. It completely shatters the illusion that you can compete with these firms by taking a 6-week Python coding bootcamp and subscribing to a data feed.
You aren't just playing a different sport, you are subject to entirely different laws of physics.
Which naturally leads to the next question. How does a firm built by physicists and topologists actually behave in the real world? How do they deploy this math to navigate today's highly reactive, deeply emotional, AI-obsessed stock market? Because the market isn't just numbers, it's driven by human mania.
To see that, we can look at Renaissance Technologies' actual data-driven pivots. The research gives us a fascinating peek under the hood by analyzing their Q4 2025 13F filings.
For those who might not know, a 13F filing is the mandatory public report that institutional investment managers with over $100 million in qualifying assets have to file with the SEC, detailing their U.S. equity holdings. It's essentially a delayed snapshot of what the smart money is holding.
Correct. And analyzing this specific data set from late 2025 is incredibly revealing. At that time, Renaissance managed approximately $64.5 billion in 13F securities spread across over 3,100 positions.
That's massive.
It's a massively diversified, highly systematic portfolio. Their top holdings show a very clear, persistent preference for scalable business models, companies with incredibly strong competitive moats, and those exposed to major digital disruptors. You see names like Palantir, United Therapeutics, Costco, Netflix, VeriSign, Kinross Gold, and Tesla.
But the research highlights one specific, massive strategic pivot they executed late in 2025. And this is where the mechanics of quantitative probability versus retail emotion become glaringly obvious. While the entire retail trading world was blindly chasing the AI hype train, throwing every single dollar they had at the ultimate AI bellwether, NVIDIA, Renaissance did the exact opposite.
They executed a massive, counterintuitive rotation. According to the filings, Renaissance decreased its stake in NVIDIA by nearly $887 million.
I need to push back on this because on the surface, that sounds insane. If I'm looking at the market in 2024 and 2025, NVIDIA is printing money. Their earnings are through the roof. The demand for their GPUs is insatiable. Every tech company on Earth is buying their chips to train large language models.
It was the darling of the market.
Exactly. So dumping almost $1 billion at the most hyped, profitable stock on the planet sounds like stepping in front of a freight train. How does a mathematically rigorous firm justify walking away from that?
Because they don't trade the narrative. They trade the structural probability. And they didn't just dump NVIDIA and sit on the cash. Simultaneously, they boosted their position in Micron Technology, ticker symbol MU, 14-fold. They expanded their holdings to over 3 million shares.
So they rotated out of the brain of the AI, the GPU, and into the memory of the AI. Let's break down the mechanics of why that makes mathematical sense.
Think about the underlying infrastructure required for artificial intelligence. Everyone, from retail traders to massive mutual funds, was crowding into the GPU market. NVIDIA was the obvious play. Because it was obvious, the trade became incredibly crowded.
Right. Everyone was in it.
And the stock became intensely expensive, trading at astronomical multiples, heavily driven by retail emotion and momentum hype. The risk-reward ratio had fundamentally shifted. The upside was heavily priced in, but the downside risk of any minor earnings miss was massive.
So Renaissance's models identified that the shape of the NVIDIA trade had deformed into a high-risk scenario.
Exactly. But what does an NVIDIA GPU actually need to process all that AI data? A GPU is incredibly fast at doing math, but it has to be fed the data to calculate. It needs massive, massive amounts of highly efficient, incredibly fast memory. Specifically, it needs high bandwidth memory, or HBM.
And Micron is one of the very few companies on Earth that manufactures that specific type of memory.
Right. Renaissance's probability-driven models likely identified a massive structural inefficiency. They foresaw a severe, impending supply chain bottleneck in the memory market, driven entirely by this incoming AI memory cycle. Building out HBM fabrication facilities takes years and billions of dollars. Supply is incredibly tight.
So they realized that while everyone was fighting over the overpriced shovels, meaning the GPUs, no one was paying attention to the fact that you can't build the shovel without the steel, which is the memory.
Brilliantly put. They identified that the less glamorous, historically cyclical, and significantly less crowded memory sector offered a far superior probability of outsized returns compared to the hyped-up, perfectly priced GPU sector.
They didn't bet against artificial intelligence. They just found a hidden structural inefficiency in how the rest of the world was betting on it.
That is the essence of quantitative mastery. It demonstrates a system built on rigorous, unemotional analysis of supply chains, order flow, and probability distribution.
Yeah.
It shows a willingness to pivot quickly and decisively when the mathematical signals change, regardless of what the financial news networks are screaming about. It is dynamic, structural intelligence, not a static robot blindly buying trendy tickers because they have AI in the prospectus.
Which brings up a really difficult practical challenge for the rest of us. This massive pivot perfectly illustrates the difference between recognizing a fundamental structural shift in market mechanics and just blindly riding a wave of retail hype until it crashes. But if you are listening to this and you aren't a code-breaking mathematical topologist, how can you tell the difference? Like, how do you filter out the garbage and identify what is actually real?
That leads us directly into a fantastic strategic framework detailed in the research called the Autonomous S Trend Radar. This is a tool traditionally used for corporate strategic innovation management, but it provides a razor-sharp method for distinguishing between sustainable market megatrends and fleeting retail trading fads.
I love a clear mental model. Let's walk through how this radar works. It breaks things down into three distinct categories based on their scope and maturity. At the very top, the largest category, we have megatrends.
Megatrends are the massive tectonic shifts in human behavior and technology. These are macroeconomic and societal changes that last 25 to 30 years and fundamentally alter all walks of life globally. The research gives digitization or global urbanization as primary examples.
Right. The creation of the internet itself was a megatrend. It didn't just change one industry, it rewrote how humanity communicates, trades, and learns. Okay, moving one layer down on the radar, we have macro trends.
Macro trends are the observable, measurable, midterm changes that exist within a megatrend. They typically follow a specific trajectory for maybe 5 to 10 years. They are significant and they create massive economic opportunities, but they don't necessarily rewrite the entire global structure. The examples given are things like collaborative consumption, which spawned the gig economy, companies like Uber or Airbnb, or the quantified self, which led to everyone wearing smartwatches to track their heart rate and sleep cycles.
And finally, at the very bottom, the most dangerous layer of the radar, we have fads or hype.
This is the noise. The research describes fads as superficial observations of the iceberg tip that have absolutely no foundational mass beneath the water. They have a very limited duration. They flare up incredibly quickly, driven by social contagion, and they have no real significance for long-term corporate or individual strategy. They burn out as quickly as they ignite.
So let's take this Itonis radar and apply it directly to the trading world we've been dissecting. Where does all this AI trading software fit?
It's a vital distinction to make. The institutional adoption of true machine learning. The infrastructure that Jim Simons and Renaissance built, the supercomputers, the colocation, that is a highly valid, incredibly powerful subcomponent of the broader digitization megatrend. It is a structural reality. It is backed by massive capital, deep mathematics, and literal physical infrastructure.
But the retail obsession. The targeted ads selling a $49 a month AI algorithm that connects to your standard brokerage account.
The radar categorizes that purely as a fad or hype. Why? Because it entirely lacks the underlying hierarchy of expertise, the rigorous data architecture, and the necessary infrastructure required to actually execute machine learning in financial markets. It is the iceberg tip with nothing underneath it. It is mimicking the vocabulary of a megatrend without possessing a single ounce of the actual substance.
It's like trying to build a massive commercial wind farm because you felt a single random gust of wind on your face in your backyard. Whereas playing a true megatrend is like building a hydroelectric dam on a massive, steadily flowing river that has been carving through a rock for centuries.
Exactly. The underlying force must be sustainable and measurable.
So, practically speaking, if you are a listener and you open up your social media feed tomorrow and see a highly produced video of a guy in a penthouse promising that his new AI tool is printing money, how should you use this radar to react?
The framework provides specific strategic actions based on the maturity of the trend. With high hype, low maturity fads like retail AI tools, the recommended action is absolutely not to act now.
Interesting.
The impulse we all feel, that FOMO, that fear of missing out, it screams at us to act immediately before the opportunity vanishes. The radar advises the exact opposite approach. Wait and see.
Wait and see. That is psychologically agonizing to do when everyone in your online echo chamber claims they are getting rich overnight.
It requires immense discipline, but it is the ultimate filter for your capital.
Yeah.
You have to coldly assess the maturity level of the trend. If a product promises immediate, effortless wealth without requiring you to have any foundational understanding of what it is actually doing, it is low maturity and high hype.
Yeah.
You filter out the noise by simply waiting. You wait to see if the tool demonstrates actual, sustainable, verifiable utility for your specific level of play over a long period of time, say an entire market cycle.
Because what usually happens?
More often than not, within 6 to 12 months, the market regime changes, the fad collapses, the accounts are wiped out, the well-spoken idiot deletes his videos and moves on to selling something else, and you have successfully protected your capital by doing absolutely nothing.
Okay, so let's strip all of that away. We've filtered out the fads, we've thrown away the illusion of magic tools, we've ignored the shortcuts, and we understand the staggering mathematical chasm between us and Jim Simons. What are we left with? If there is no shortcut, what is the actual proven formula for someone, especially a young student, who is just starting out looking at this massive mountain of finance to build real wealth and true market mastery?
We find that answer deep in the research, and be warned, it is the most unglamorous, brutal, exhausting formula imaginable.
Yeah.
But it is the only one that actually works.
I am ready for the hard truth. Lay it out.
The dossier outlines this exact formula. U plus butt power plus books plus charts plus hours equals positive results.
Let's repeat that because it is the absolute antithesis of modern marketing. U plus butt power plus books plus charts plus hours equals positive results. This formula entirely rejects the external special tools narrative. It places the brutal burden of success entirely on the human agent.
It is absolute extreme ownership. But before we break down the individual steps, the research points out an incredibly fascinating biological urgency to this formula, specifically tailored for young students beginning their finance careers. There is a biological reason why you must embrace this formula early in life.
The biology of trading. Why is youth such a critical factor? Does the market care how old you are?
The market doesn't care, but your brain does. It comes down to the biology of neuroplasticity. The research issues a stark warning. The older you get, the more difficult it is to fundamentally change how you process complex information, because the brain quite literally hardens in its neural pathways.
Wow.
While human beings retain some level of neuroplasticity throughout their entire lives, the efficiency, speed, and depth of acquiring high-level, complex mathematical and technical skills is at its absolute biological peak in youth.
So if you are a 20-year-old student, your brain is currently a highly absorbent sponge for complex geometry, topology, statistical analysis, and pattern recognition.
Exactly. You must leverage that temporary biological window to physically build the incredibly complex neural pathways required to process multidimensional market data, like a quant. If you spend your 20s watching get-rich-quick YouTube videos and searching for shortcuts, you are wasting your peak neuroplasticity on garbage. Deferring the hard foundational work means trying to learn it in your 40s when the biological cost of acquisition is exponentially higher and the brain resists new foundational paradigms.
You have to pour the concrete while it's still wet. Okay, let's break down the steps of this personal trading curriculum for the student who is ready to do the work. Step 1, you, the agent.
This is the psychological foundation. It is about cultivating extreme personal accountability. You must recognize from day one that you are the central, irreplaceable agent of your financial life. You are the sole decision maker. You cannot offshore your financial destiny, your risk management, or your strategic intent to an algorithm. You own the wins, and far more importantly, you own the devastating losses. When you lose money, it isn't the market's fault. It isn't the algorithm's fault. It is your fault.
That is a heavy burden to accept. Step 2, books, the foundation.
This step leverages that neuroplasticity we just discussed. This means building a deep, unshakable theoretical foundation. And this does not mean reading superficial trading paperbacks with titles like Mindset of a Millionaire Trader. It means diving into the grueling academics, complex mathematics, geometry, statistical probability, market microstructure, and deep financial theory.
You have to learn the underlying language of the market before you can speak it. Jim Simons didn't start his firm by staring at a candlestick chart. He started by mastering differential geometry over decades of academic rigor.
Step 3, charts, the empirical data.
How does this differ from the books?
The books are theory. The charts are the raw, unfiltered empirical data of actual human economic behavior. Once you possess the mathematical theory, you must apply it to reality. This is where you study historical price action to see how variance and probability actually manifest when real capital is on the line. This is where you attempt to identify those true structural market inefficiencies that your theory suggests might be hidden in the noise.
And finally, step 4, which is my absolute favorite term in this entire body of research, hours and butt power, the crucible.
It is the perfect, visceral term. Butt power is the brutal, unyielding discipline of physically sitting at the desk. It is the willingness to remain seated in the chair, staring at the raw data, manually journaling your observations, analyzing patterns relentlessly, day after day, year after year, when every instinct in your body wants to go outside or find a shortcut.
The research explicitly states that the ultimate goal of applying this massive amount of butt power is to reach the top 5 to 10% of market operators who can navigate the chaotic environment with ease.
Yes. And there is absolutely no shortcut to that elite tier. You cannot buy your way into the top 5%. You cannot rent a software program that puts you in the top 5%. You can only sit your way in. through thousands upon thousands of hours of concentrated, agonizing intellectual labor.
I just love the deep irony of that. We live in an era of quantum computing, large language models, artificial intelligence, and instantaneous global communication networks. And the absolute most valuable, irreplaceable asset you can possess in the financial market is still butt power, just the raw endurance of your own human attention span.
It is the ultimate equalizer. The supercomputer can process the data infinitely faster than you can, but the human operator must build the physical endurance and the neural pathways to actually understand and deploy that data.
But let me push you on this, because it's a great theory. It sounds incredibly noble, very stoic. But what does this actually look like in practice? What does it look like on a random Tuesday morning for a 20-year-old finance student who is sitting in their dorm room, staring at a laptop, trying to implement butt power? How do you actually build this deep market instinct from the ground up without getting overwhelmed?
That brings us directly into the daily mechanics of building market intuition. The research actually constructs a specific daily routine designed specifically to build pure foundational intuition without relying on any automated software.
I am taking notes. Walk us through the Tuesday morning routine.
The overarching rule of this routine is to master the craft first. You must absolutely never deploy advanced technical tools or algorithms until you are fully, completely capable of operating profitably without them. So the Tuesday morning routine starts with pure observation. You open your platform and you pull up raw price charts.
Raw meaning what?
No indicators, no moving averages, no RSI, no MACD, no algorithmic overlays painting buy and sell signals on the screen, just pure price action and volume. Bars on a screen representing human buying and selling.
Just staring at the raw data, that sounds like watching paint dry.
It is excruciating at first,
Yeah.
but you are observing the rhythm. You're watching how price behaves around certain levels, how liquidity enters and exits the market at the open, how the bid-ask spread widens during a news event. You are absorbing the pulse of the tape. Then, after observation, you dedicate a strict block of time solely to studying fundamental mathematical concepts, building that theoretical foundation from the books.
And then the crucial final step, the manual journaling.
Yes, you don't just record your paper trades on a spreadsheet. You manually write down the why behind price movements. You force your brain to articulate a coherent thesis for why the market behaved the way it did that morning. You write, price rejected at this level because the order book showed massive institutional supply and the volume divergence suggested exhaustion. You force yourself to think structurally.
It's exactly like forcing a musician to practice scales on a basic, unamplified acoustic guitar for years before they are ever allowed to plug into a massive Marshall amplifier with heavy distortion pedals. If your foundational technique is sloppy on the acoustic guitar, the amplifier isn't going to fix it. The amplifier is just going to make your mistakes incredibly loud and obvious to everyone.
That is a phenomenal way to understand it. An AI trading tool is just an amplifier. If your foundational intuition is flawed, if your risk management is sloppy, an AI tool will simply execute your flawed strategy much faster and much more efficiently, draining your account at record speed. This daily routine of sustained, unamplified analysis and emotional regulation is how you train the brain's neural pathways to absorb the actual physical rhythm of the market.
But in this incredibly solitary routine, just you, the books, the raw charts, and your butt power, where does a mentor fit in? Because the research heavily emphasizes the need for mentorship. How do you find guidance without accidentally falling prey to one of those well-spoken idiots we talked about earlier? How do you know if a mentor is real?
It is a vital distinction, and it comes down to what the mentor actually hands you. A fake mentor, a marketer, hands you a tool. They give you a secret execution script or a proprietary indicator and tell you to just follow the green arrows. They want to make you dependent on their product.
Just subscribe to my Discord, copy my trades, and you'll be rich.
Exactly. But a true, seasoned mentor operates in the exact opposite manner. They do not give you shortcuts. A true mentor sits with you and guides you in understanding the broader, complex context. They help you interpret those hours of raw, confusing chart data. They challenge your underlying assumptions. When you propose a trade, they force you to articulate your strategic intent out loud and defend it mathematically.
So they don't give you the answers, they just relentlessly ensure that you are asking the right questions.
Precisely. They foster deep critical thinking. Their ultimate goal is to build your internal intuition to the point where they make themselves entirely obsolete. They want you to outgrow them.
This entire process sounds absolutely exhausting. It sounds like years of grueling, frustrating, solitary work. But the research takes a really fascinating, almost philosophical turn here at the end. It argues that this demanding, brutal path doesn't just build a better financial portfolio, it fundamentally changes the ethical character of the human being doing the trading.
And this is perhaps the most profound part of the entire analysis. We aren't just talking about making money, we are talking about how the method of making money alters your psychology. The course material draws a very sharp, very deliberate contrast between two types of market participants. On one side, you have the practitioner who possesses a clean conscience because they have earned every single cent through the grueling application of their own merit and hard work. On the other side, you have the profound spiritual and ethical rot of those who sell fraudulent trading shortcuts.
Let's look at the psychology of the deceptive side first. Let's look at the internal life of the well-spoken idiot who sells the fake AI robot. Because on the outside, they look incredibly successful. They have the cars, the watches, the lifestyle.
The research analyzes the invisible psychological burden of that deception. The person who lies about their mentorship, who lies about the efficacy of their tools, or who fakes their trading track record, they have to constantly carry that lie around with them. It is an immense, exhausting psychological weight. They're constantly managing the illusion, and inevitably, because the financial market is the ultimate ruthless arbiter of objective truth, they will face the public spectacle of their own failure. When the market regime shifts and their fragile tools inevitably collapse, their entire identity shatters.
They're living in constant low-grade terror of being exposed by reality.
Exactly. They know they are frauds. But in stark contrast, consider the psychology of the trader who builds sustainable wealth through genuine, merit-based, rigorous mastery. When you have spent the thousands of hours, applied the butt power, survived the drawdowns, and built your own internal intuition, you develop a profound, unshakable sense of integrity. You know exactly what you are capable of, and you know exactly how painful it was to achieve.
The phrase from the text, "earn every single cent," really stands out to me. When you really think about it, that philosophy completely insulates a trader from imposter syndrome. If you get rich because you bought a lucky meme coin, or because you blindly followed an AI robot during a massive bull market, deep down in your quiet moments, you know you didn't really earn it. You know you got lucky, and you are terrified the market will take it back because you don't know how to repeat the process.
But when you rely on your own hard-won mastery, market crashes don't destroy your identity.
Right. Because your edge isn't a rented software program that can be turned off or a subscription that can be canceled. Your edge is literally built into the physical neural pathways inside your head. You own it forever. If they take all your money away, you know how to build it back.
That is the essence of the clean conscience. And the research brings it all back full circle to Jim Simons as the ultimate case study in this kind of deep integrity. Simons didn't just build wealth. He built unassailable, universal respect that lasted for decades across both the academic and financial worlds. And crucially, his immense success allowed him to display what the text beautifully calls a greatness of spirit late in his life.
The philanthropy.
Yes. Simons didn't just hoard the billions of dollars he generated through mathematical rigor. He pivoted to philanthropy on a massive world-changing scale. He established the Simons Foundation. He gave away billions of dollars to fund critical, foundational scientific research in areas that most people ignore because they aren't immediately profitable or glamorous. He funded deep research into the biological mechanisms of autism, the complexities of cellular biology, and even the fundamental physical origins of the universe itself.
That is just an incredible arc of a human life.
Right.
From breaking Soviet codes for the government in the Cold War, to breaking the chaotic noise of the financial markets, to ultimately trying to break the code of the universe itself to help humanity.
It proves a vital, undeniable point. Wealth that is generated through rigorous, truthful, and disciplined engagement with the harsh reality of the market can be translated into profound, real-world good. It stands as the ultimate, towering counterargument to the ephemeral, empty, deceptive culture of the get-rich-quick marketers on your social media feed. Simon showed us exactly what is possible when human intellect and discipline are pushed to their absolute limits.
Wow. Okay, let's try to synthesize this massive journey we've been on today. We started by dismantling the incredibly deceptive, incredibly expensive hype surrounding retail AI trading tools, the magic tool fallacy that preys on our biological desire for a shortcut to wealth. We explored the actual market mechanics of why those hard-coded tools break down the second liquidity dries up and the market environment shifts.
We then redefined the proper structural relationship between technology and the human trader using the golfer and the caddy metaphor. We established that while AI can gather complex data and run probability models, The human agent must retain total responsibility for strategic intent, maintaining the conviction to hold through variance.
From there, we looked at the literal pinnacle of what quantitative mastery looks like with Jim Simons and Renaissance technologies. We saw the staggering, almost comical difference between a retail trader drawing lines on a chart and a topologist utilizing three-dimensional quantum field theory to decode the invariant properties of market noise.
We analyzed how that level of mastery manifests in real-world, data-driven pivots, like their brilliant rotation out of the hyped GPU stock NVIDIA and into fundamental memory infrastructure like Micron, based purely on supply chain probabilities, not emotion. We also provided the Itonic Tread Radar as a strategic framework to help you filter out those fleeting, low-maturity fads and protect your capital by simply waiting.
And finally, we brought it all down to the granular, daily level. For the young students out there with peak neuroplasticity, we laid out the unglamorous, unavoidable biological formula for success. You plus butt power, plus books, plus charts, plus hours. We talked about building that raw intuition on the acoustic guitar first, seeking mentors who force you to think rather than handing you scripts, and ultimately earning the profound peace of a clean conscience in your financial life.
It is a demanding, exhausting path. But as the research makes abundantly clear, it is the only path that actually leads to sustainable generational mastery. There are simply no shortcuts.
There really aren't. And as we wrap up this deep dive, I want to leave you with one final mind-expanding thought to explore on your own. Something that has been lingering in the back of my mind ever since we brought up Jim Simons' specific mathematical background in topology.
The Chern-Simons framework.
Exactly. Think about this. If Jim Simons achieved absolutely unprecedented financial dominance, the single greatest algorithmic trading record in the history of humanity, by successfully applying three-dimensional topological quantum field theory to raw market data, it implies something profound about the nature of money itself. It implies that the stock market isn't just a chaotic, random casino driven entirely by unpredictable human emotion. It suggests that human economic behavior, when you zoom out far enough, when you view it from a high enough mathematical altitude, behaves almost exactly like physical matter governed by undiscovered natural laws.
It's just a fundamental structural reality to human interaction.
Right. It makes you wonder, if the financial markets actually have a physical topological shape that can be measured and predicted, what other unseen geometries are driving the world around us, just waiting for the right mind to sit down, apply some serious butt power, and decode them?